Okay, we're going to finish up the slides on Chapter 7. We're going to get into talking about how to get this growth rate. And we've got a bunch of little equations that surround how to estimate growth rate. And so we'll have to keep track of those. I'll tell you when that comes up. It's pretty soon here. And so there's a couple of equations you have to keep in your mind when we're going through the examples, and it helps if you have them written down or something like that, or have it available to you on the side to look at. So now we're going to talk about this growth rate a little bit more, because if you recall last Monday, we looked at something called the Gordon growth model, right? That's when I joked that it was named after Gordon Gekko from the movie Wall Street. It's not really, but just remember it's the Gordon growth model, and it was basically the cash flow or dividend next period, all divided by R minus G. So this G, this growth rate, is probably about the most important thing that goes into this model. So let's talk about it a little bit more. So when estimating this G, a lot of times investors might use forecasts for the overall economy, and in that case, they often use GDP forecasts. GDP forecasts are pretty easy to get. You can look them up from different governmental organizations, countries all around the world. But sometimes a company might need something more specific than the overall economy. In that case, there are a number of economics consulting companies that people will use, and these consulting companies, they'll estimate GDP as well for the overall economy, but then they'll break it down into all these different industries within the overall economy. So there might be like automotive industry, heavy equipment for construction industry, and might be more usable for some companies. Give you an example. I worked for a company that had lots of divisions, and in one division, we used just GDP forecasts to estimate future growth rates. Because when you're putting together forecasts, you have to come up with a growth rate. And that growth rate is what gets applied to sales if you're like working within a company to come up with sales forecasts in the future. And this particular division, they found by analyzing their sales over history compared to GDP, it was pretty much in lockstep. So they just used GDP forecasts to forecast their sales in the future when they're making financial plans. But for another division I was working at, they used forecasts from an economics consulting company who used to forecast things for something like oil and gas spending, computer spending, and they would kind of take an average of a couple different industries, and that worked for them. So all different companies have different ways of coming up with a growth rate, G, and investors use different ones as well. And some companies just like kind of come up with their own guess. Sometimes people would call it a sophisticated wild guess or a swag. And a lot of times outsiders may be a little skeptical of those guesses because there's an incentive to like say, hey, I'm going to grow really, really big and bigger than you might actually grow, just so you can get investors to come in and be able to do all the things you want to do. So it is good if you get forecasts from people outside your particular company to use for your forecast, and it provides a little more legitimacy to the financial statements, especially those looking forward into the future. Now, for a company that's relatively kind of stable, we have some formulas that we're going to cover now that help you estimate G. And it's pretty basic, but there's like 2 or 3 equations we'll have to remember, but it provides a nice fallback if you're not going to use overall, GDP growth. And this is good too in case you're coming up with a situation where a company might change maybe their dividends or change how much they want to keep and reinvest back in the business. So here's some of the formulas, and these are going to, if it's possible, if you could just write it down on a piece of paper next to you, it might help you when we do the following on examples, because you're going to kind of forget these as we go on. So the first kind of definition is called the payout ratio. And this is how much of a company's earnings it pays out as dividends. So if you think of net income or earnings, how much money a company has left over after all's said and done, that's the money they have to decide what they want to do with. What part of that is going to go to investors as dividends? That is called the payout ratio, the percentage of net income or earnings that gets paid out as dividends. And so it just equals this. Payout ratio equals dividends divided by net income. And in this is kind of a model of growth and how to forecast it. And in this model, I should also say that companies can only do 2 things with their earnings. They can either pay it out as a dividend to investors, or they can invest it back into the business to help them make their business bigger and better, right? So there's only 2 things they can do: pay out as dividends or reinvest it back into the business. And that leads us to something called the plowback ratio. The plowback ratio tells you what percent of net income or earnings goes back into the business. The thing to remember here is that, and I'm gonna annotate something here. Give me a second. The payout ratio plus the plowback ratio is always equal to 1. Now, so why is that? It's just based on the assumptions of this model. Because remember, the company has their earnings or net income, and they can only do 2 things in this model. They can only pay dividends or put the money back into the business and reinvest it. Okay, that's why payout ratio is how much goes to dividends, and plowback ratio is how much gets reinvested back in the business. So it has to add up to 100% of the money you've got, the earnings. And so that's why right here it says plowback equals 1 minus the payout ratio. So that's how you can get the plowback ratio. To get the plowback, you have to know the payout. Okay, and whatever the company doesn't pay out basically goes back into the business and reinvested. So make sure you put a star on this equation. Payout plus plowback ratio equals 1, and I just rewrote it here as plowback equals 1 minus the payout ratio, because in a lot of the problems that we do, that's kind of how we'll use that equation. Any questions on that? What the payout ratio is, or what the plowback ratio is? Okay, this leads us to how we're going to estimate growth, G. And it's called the sustainable growth rate here. And it's a formula that works better for kind of a steady state company, not something like Tesla or Amazon, but maybe something closer to PG&E or Procter & Gamble, something like that. So the equation is that the growth rate, G, is equal to return on equity multiplied by the plowback ratio. So where does this come from? So think about, return on equity is kind of how much your equity investment in the business will grow every year, right? That's your return. So if equity is $1 and the return on equity for a company is 10%, then it returns $10 every year, right? And so then we multiply that return on equity by the plowback ratio. And plowback basically says how much of the total return that the company gets every year, which is basically what net income and earnings are, how much of that return goes back into the business. And so what you end up with is the growth rate. So how much of the returns you put back in the business every year helps it keep growing and growing and growing extra if compared to not putting anything back into the business. So that's kind of that's the equation we're going to use for the next couple slides. So kind of keep that in the back of your mind. So how does growth affect the value of a company? And last Monday we were looking at the dividend discount model, right? And it's pretty clear to see, right? The higher the dividends for a company, the higher the value you get, because what we do in the dividend discount models, we take the present value of future dividends. So higher the dividends, higher the present value, right? But when it comes to a choice between paying dividends or reinvesting back in the business, that kind of logic can be turned around a little. Because if the company invests more money into their business, they can grow more in the future, and eventually their dividends could be higher, right? Because remember, we have these two decisions where a company can either pay out dividends or reinvest it back into the business. So if a company chooses to stop paying dividends and then reinvest all that money back in the business, their dividends are going to be lower now. But by reinvesting it back in the business, they're able to grow the business more, so that's such that in the long-term future, the company could actually be worth more. And so hypothetically, dropping the dividend could increase the value of the company because it could increase the growth rate if the company's making good investments. And so the logic behind this goes that lower dividends leads to a lower payout ratio, right? So they're paying out less. And we know the payout ratio is dividends divided by net income, right? So basically a lower payout ratio then is also going to lead to a higher plowback ratio. So either they pay it out or they plow it back into the business. So they're going to plow more back into the business now. And we know these two sum to one, right? So that's why if they're going to reduce the payout, it has to increase the plowback ratio because there are only two things they can do with their money. This higher plowback ratio is going to lead to higher growth rates then. And so we know that because the growth rate is a function of the plowback ratio. They invest more back into their business, they're going to get a higher growth rate. So that's the key. That's where a company, if they lower the dividends, they can theoretically increase the value of the company because it's going to increase their growth rate. Here's the model that we ended with after the last class, Monday. And if you recall, this was the dividend discount model. And we have dividend here at time 1, dividend at time 2, and then ... until we end our forecast. And that last year of our forecast, we add the final dividend plus the value of the stock. And what we did on Monday is in place of the stock price P, right here at the very end, right, we put in that Gordon growth model, which was the dividend the following year, H plus 1, time H is the end of our forecast here, right? So dividend at time H is the final dividend. But to use the Gordon growth model, you do have to get the dividend for the next year after that. And that's why you see H plus 1. Then you divide that by R minus G. That's the Gordon growth model. And there's G, right? So what we're saying here is that when this G gets bigger, right, it actually makes this whole term right here bigger as well. And that's why the value of the stock can go up if G goes up. So another term for this, the value of the stock at the very end, we sometimes call that the terminal value. And the terminal is like the end of our forecast. And so that's the value of the stock at the end of our forecast, this div divided by R minus G. So if a company changes their policy about how much to pay as dividends, how much to pay out as dividends, and how much to plow back to reinvest in their business, it could change the value of the company, right, by changing the growth rate. So let's do a little example of what that means. In this example, our company forecasts to pay $8.33 in dividends next year. And this is 100% of earnings. So right off, you should be thinking that the payout ratio is 100%, okay, or 1.0. And then it says this will provide investors with a 15% expected return. So that must be our R, right? R, the discount rate, is 15%. That's the required return. So we got a couple good pieces of information there. So then the question goes on. Suppose we decide to plow back 40% of the earnings at the firm's current return on equity of 25%. So this is an alternative scenario, right? What if, this is asking, we plow, instead of paying 100% of earnings out as dividends, what if we plow back 40% of the earnings as reinvestment into the company? Well, we kind of just looked at and we just saw, well, it could mean that the growth rate's going to go up for the company, right? We know that's what it could mean. And also the firm's current return on equity is 25%. So return on equity, we need that for that growth rate formula. G equals return on equity times plowback, right? So we know we're going to need that. What is the value of the stock before and after the plowback decision? Okay. So we're doing growth rates, and we know what the dividend is next year. So it looks like it's going to be the Gordon growth model. The Gordon growth model is basically the dividend next year divided by R minus G. And so I think we're going to be able to calculate this with the information we have. So first, we're going to use the payout and plowback ratios to calculate G in before and after in the first scenario, and then later on when they change to a plowback of 40%. So we'll calculate the G's first, and then we'll use the Gordon growth model to calculate the stock price before and after as well. So that's the setup. Let's take a look at how we can do this. So on the before side, a couple things we know from the question on the previous slide and from the lecture today. We're going to need to use this formula. G equals ROE, return on equity times plowback. We're given the following information. We're given that ROE equals 0.25. We're given that in the before scenario, the payout is 1.0 or 100%, right? And we also know that the payout ratio plus the plowback ratio always sums to 1. All right, so what does this tell us? We need to calculate G. And we know the ROE, that's 0.25. So we need the plowback ratio for this before case. So what is the plowback ratio in this example? Right, because we know the payout ratio is 1. And that must mean the plowback is equal to 0, right? Yeah, 0 plowback. So now when we go ahead and calculate G, the growth rate, we're going to be multiplying by a plowback of 0. So that's going to give us a growth rate of 0. So it's kind of a good way of thinking about things. You know, if a company doesn't keep any of its profits at all, it's how are they going to grow the business, right? Because they have to, if they're going to reinvest in the business, they have to pull some money out of their profits and put it back into the business. Has anybody heard of the nickname for an investment or company that's run in such a way that they don't put any money back into the business, but instead they just take off all the cash? There's a nickname for it. It's a cash cow. You may have heard that before. A cash cow is defined, I don't know if this is in Webster's or anything like that, or Cambridge Dictionary, but in the business world, it's defined as a business where you do not invest any of the money at all. All the money gets taken out, and you're basically just running the business for the cash that it generates with no reinvestment. Companies will do this. They'll run a business as a cash cow if the fundamental industry that they're in isn't growing at all. Because if they're in an industry that's not growing, it doesn't, you know, why reinvest in the company if their fundamental marketplace isn't growing at all? So this does happen. It's kind of a real scenario, and it's what is known as kind of a cash cow in the business world. Let's look at the other situation. This was the after, right? And we want to find G, the growth rate again. And we've got some data from the problem. We know the ROE is still 25%. In this situation, the plowback is 0.4. Okay, and we want to find G. So we pretty much have everything we need, right? We got ROE and plowback. So let's go ahead and calculate G, and we end up with 0.1 or 10%. So now our G is 10%. So that's good to know. Now I am going to calculate one more thing, because on the next slide, when we calculate the value of the stock, we're going to need to know the dividend. Right, and in this after situation, since we're plowing back 40% of the money back into the business, that only leaves 60% of the money to go out and be paid out as dividends. Right, so because we know payout plus plowback equals 1, and if the plowback is 0.4, that must mean that the payout ratio in this after scenario is going to be 0.6. Okay, so just keep that in your mind for the next slide. So we got our two growth rates. I think we're good to go to the next slide. Does anybody have any questions?
Wait, I'm confused on how you're saying it's 0.6.
It's 0.6 because the plowback ratio is 0.4. That's a given right here, right?
Okay.
And we know the fundamental equation for this is that the payout plus the plowback always sum to 1.
Oh, okay.
So if the plowback is 0.4, then the payout must be 0.6.
Okay. Makes sense. Thank you.
All right, no problem. No, this is stuff. It's like, it's simple, but it's complicated because we have a lot of little equations, and we keep going through all these examples, and everything's like multiple steps from here to there. So, and so no problem with that question. I saw we had a chat when I was asking about the types of companies that don't reinvest a lot of their own money back in the business. Timothy said a REIT, a real estate investment trust. And yeah, that's a pretty good answer, because you know, the way real estate investment trusts are that real estate investment trusts don't have to pay taxes at their level, right? It's all taxed on the investor's level when they get their dividends. But to be able to operate as a REIT, they have to pay out. And tell me if I'm wrong here, Timothy, is that they have to pay out at least 60 or 70 some percent of their profits have to be paid out as dividend by law for them to be able to be classified as a real estate. Yeah. Using the Gordon growth model to quantify changes in policies. So let's now calculate the stock price before and after in this situation. So before, we know we can calculate the stock price using the Gordon growth model. And to do that, we take the dividend next year, div at time 1, and divide it by R minus G. We were given the dividend at time 1 of 833, and we're given a required return of 15%. And then we also calculated on the last slide that the growth rate G was 0 for this example. So that's enough for us to calculate the stock price right there. And so we end up getting 8.33 divided by 0.15 minus 0, and that equals 55.56.
Does that come from the info from before, like a couple slides back?
Yeah, that's the investor required return.
Oh, okay, that's right.
Yeah. Yeah, this is a kind of a long problem. Let's take a look at the after now. So we'll use the same equation. We need the dividend though, because we don't know what the dividend is in the after. We only know that they started reinvesting more into the business, which must have mean there was less left to pay out as a dividend. So we're gonna have to calculate that dividend. We know that the plowback was changed to 0.4, and then we saw how if a plowback is 0.4, the payout must be 0.6 because they always add up to 1, payout and plowback. All right, so that means the dividends are going to be 60% of earnings, because that's what the payout ratio is defined as. If you look at you know, your slide two slides ago with the equations. All right. We know that R is 15% and the G is 0.1. We just calculated that G on the previous slide. So now we just need to calculate the dividend at time 1 to be able to solve this problem. And we're going to use this definition, right? The payout ratio is equal to the dividend divided by net income. So if we plug in what we have, we know the payout ratio is 0.6. We don't know the dividend, but we know the net income at time 1 is 8.33. So now we can use a little bit of algebra and we can solve for the dividend at time 1, and we get it equal to 5. Now we have everything we need to plug into the Gordon growth formula to calculate the value of the stock. And so it's going to be the dividend of 5 all divided by R minus G, which is 0.15 minus 0.1. That gives us a price of 100. So wow, check that out. So the stock price went from 55, 56 to up to 100. So that's just an example to show you how sensitive the value of companies is to changes in growth rate. And that's why a company like Tesla or Amazon will have a huge price to earnings ratio of 40, 50, 60, 70, 100, whatever. But a company like PG&E will have a price to earnings ratio of like 15 or something like that. It's because people are willing to pay a much higher price for a company who's growing a lot more. This difference in value from $55 up to 100, sometimes it's referred to as the present value of growth opportunities. And when we looked at the stock at 55, growth was 0. And then when we started plowing back 40% of earnings back into the business, the growth rate went up to 10%, right? So this increase in value from 55 up to 100 is all because of the growth rate going up to 10%. So let's go ahead and do an example here. So I'm going to give you guys another situation, and I want you to go ahead and calculate the value of the stock given the following situation. So ABC stock has a 20% ROE, earnings per share are $4, and sometimes people refer to earnings per share as EPS or net income per share. And the plowback ratio is 0.3. What is the current stock price of this company using Gordon's growth model? If investors expect a 12% return on stock, and also calculate the PE ratio. Let's think about this. What's the equation that we have to solve for? Gordon growth model, right? It kind of says it right in there. ROE, and so this is the information that we have in the problem. And then this is what we have to solve for. So let's take this step by step. We'll do this kind of together. Do we know the dividend at time 1?
No.
No. Okay. So we're gonna have to solve for that. Do we know R?
Yes. 0.12.
Exactly. Do we know G?
No.
No. Okay, so we've got to solve for the dividend and G. Let's see. Let's go ahead and solve for the dividend first. And the dividend, we know from that one equation before about the payout ratio, the dividend is related to the payout ratio. So this was we know that when you add up the plowback ratio and the payout ratio, it always equals what?
1.
1, right? So you can see right here, I said the payout ratio equals 1 minus 0.3, which is equal to 0.7. So that's where that came from. So because if we know the plowback is 0.3, basically the payout must be 0.7, okay? Now, once we have the payout ratio, now we can calculate the dividend, because the dividend is just going to be that payout ratio multiplied by net income, and it's going to be 70%, 0.7, times the $4 per share of net income or earnings. And so that leaves $2.80 that's going to be paid out as dividends. Now we want to estimate G. And G is equal to ROE times plowback. So that's going to be 0.2, which we're given, times by the 0.3, which we're also given. And so that means the growth rate is 0.06. And we know R is 12%. So that means we have enough to calculate the Gordon growth model. It's going to be the dividend divided by R minus G, which is 2.8, which we just calculated, all divided by 0.12 minus 0.06. So that would be the stock price in this example. Remember, the payout ratio is defined as dividends divided by earnings or net income. That's where that formula right there comes from.
So you just kind of reverse the equation to get dividends by itself in order to kind of solve that. Okay. Is this kind of like a common example we'll see on like a homework or quiz?
Yeah.
Okay.
So to calculate the PE for the earnings part, do we use $4 or do we use the 2.8?
Let's see. So it's going to be price per share divided by earnings per share. So what do we get for the price per share?
46.67.
Right. And so then we divide that by the $4 earnings per share. And so what's that about?
11.67.
Is it good for that ratio to be like big or small?
It depends on your point of view. If you own the stock and you're planning on selling it, you want it as big as possible. But maybe if you're buying a company and you want to pay as little as possible, maybe a low PE would be good then.
Okay.
It's kind of like, is it good for a company's stock price to be high or low? It kind of depends on your point of view. But there are a couple caveats. When it's really, really low, there's probably something wrong with the company. Something bad happened. And when it's really, really, really high, maybe just people are just crazy about owning the stock and they're just willing to pay whatever. Or the earnings is like 1 cent per share. It's like a really minuscule number, right? And so when you divide by a minuscule number, you could get a somewhat inflated PE ratio. So really high or really low, it's kind of a unique situation. I mean, all things being equal, it's good to have a company that's growing, right? And growing companies will have generally higher PE ratios. And if you were to look up a PE ratio for a company that lost money, has negative net income, they won't show a negative PE ratio. Instead, when you go look it up on a financial website, you'll see N/A, like not applicable. They just won't display a negative PE ratio. Because obviously you can't pay a negative price for a stock. That means they would have to pay you to take it off their hands. All right, we're going to switch gears a little bit now And we're going to talk about predicting stock returns and the efficient market theory. The efficient market theory basically states that all information available in the world is incorporated into the stock prices. And what this basically means then is that you can't really predict where stock prices are going. The reason is that if all the information is already in the stock price, in other words, it's kind of, some people say that the information is baked in, kind of like baking a cake. All the ingredients, all the information is already in there. The only thing that will change a stock price is if brand new information comes out. And the idea is that brand new information is not predictable. Therefore, stock returns are unpredictable because you're waiting for new information and you don't know when that's going to be and you don't know what it's going to be, good or bad. Now keep in mind that this is like a theory of the perfect stock market, and it's not necessarily what we see. Okay, and so this is, I don't know if you've heard the term a straw man, right? A straw man is something you put up and then it's just an idea, and then you start taking shots at it and you start saying, hey, this is wrong, this is wrong, this is wrong. So this is kind of like the perfect model of the investing world, and it's kind of where we start. And then we start doing research and we try to figure out, okay, where is this wrong? So the efficient markets is wrong in a lot of places, but it's a good general model such that for most investors, the stock markets are pretty unpredictable, right? I think most people would agree it's not easy to earn, to beat the market, earn higher than the average return on the market year after year after year. Because if you look at the average returns for mutual funds, if they can just do as well as an index fund, give you an example. One of the most popular indexes is called the Standard & Poor's 500 Index, or just the S&P 500 Index. And it has like 500 of the most influential, biggest companies from different industries, all put together into this like one imaginary stock portfolio. And Standard & Poor's publishes the value of that stock portfolio every day, all day. And investors look at that to get an idea of how the overall market's doing. Because I think within the S&P 500, something like, 70% of the total value of the stock market is pretty much in those 500 companies. It's a huge number. It's not exactly 70. I don't remember what it is. And if you just take the average of that, most investors can't beat that. Most mutual funds, professionally run mutual funds, can't beat that average. A lot of hedge funds, they can't beat that average. And so most financial advisors will say, because it's really hard to predict stock returns, you're better off just investing in an index fund, excuse me, like the S&P 500 index fund. And you kind of just like set it and forget it and don't worry about trying to time the market or pick stocks. So that's kind of where the market is for probably 90% of the people in the world. In that's what financial advisors will tell you. But there are still people who will try to sit and pick stocks, thinking that maybe they have more information than the rest of the market. Okay, so, but, the evidence is kind of against it. Excuse me, against people doing well by trying to pick stocks. So that's the bad news. I hate to deflate you guys. I know you're looking for some stock picks, but that's what all the evidence says from research. So this efficient market hypothesis, there are some spots where it doesn't seem to be totally random, the stock market. And what I mean by that is there are some spots, some investment strategies that seem to be predictable. And this is what especially hedge funds search for all day long. They search for different strategies to trade on, or they search for insider information to trade on. And so here's how we look at this efficient markets. We break it up into 3 segments. We break it up into the weak form, semi-strong form, and strong form. I apologize for the wording of this. I didn't make this up. But here's a good way to think about it. Weak form efficiency, what it does is when we define weak form efficiency, we say we're going to look for efficient markets, but just in this one category. And this one category for weak form is like historical stock prices. So weak form efficiency looks at historical stock prices to see if markets are efficient when you use all historical pricing information to try and pick stocks. Well, it is pretty efficient. It's not 100% efficient though, because we do find some instances where people have invested in huge supercomputers and they try to get market pricing information faster than other people, and they've been successful, and they do make pretty good returns. The semi-strong form looks at financial information like financial statements. So if you were to analyze financial statements of all the companies in the stock market, could you use that information to pick winning stocks? That's what we ask when we analyze semi-strong form market efficiency. And here again, we've got some mixed results. There is no one single strategy of analyzing financial statements that'll make you a winner every single year. We do find some strategies that have some really, really good years, but then they have a couple bad years, followed by a couple really good years. But when you look at it over the long term, some of those strategies seem to play out pretty well, where you get a couple extra % return on your investment than someone who does just like an index. The last one is this strong form. And what this does is it includes private information. So if you had private insider information about a company or stock, could you predict those stock returns? In this case, it turns out that's probably one of the biggest things you could do to be able to pick stocks, is to get private information, because it does exist and it's not all built into the stock prices yet. So those are the 3. So it goes, weak form is historical stock prices, semi-strong form financial statements, strong form insider information. That's kind of the best way to think about it. So the next couple slides are basically going to look at some examples of kind of where we see this. The examples of where the markets are perhaps not efficient. Before we do that, though, when we look at weak form efficient markets, the reason there's a picture of a blue man with a hat and an umbrella is because there's a relatively famous book called A Random Walk Down Wall Street. And the theory is that, you know, there's someone walking down the street and they're kind of walking randomly and you don't know where they're going. And so they're saying that's kind of like how stock prices are. And so A Random Walk Down Wall Street, it's a book by Burton Malkiel, M-A-L-K-I-E-L. And he goes through a lot of this research into showing how most markets are really efficient. And you can't predict stock prices. And so weak form, we do find it's pretty hard to predict stock prices. But there are some people who try to do it still. And that area of finance is called technical analysis. If you were to, I don't know, do some searches on investment strategies, you'll probably start seeing ads on your computer for different people who are selling training on how to invest and, you know, make a lot of money sitting in front of your computer by trading, I don't know, trading currencies or futures. And you'll get a jet airplane after maybe doing this for a year. And all you have to do is sign up for their training program. I don't know, $199 a month for 3 months, and you'll do really well. Most of these strategies are technical analysis. And what they're doing is analyzing patterns of prices and trading volume to try and predict where prices are going. Some of this is for real, and some of it may be a little hokey. People who don't believe it, they call the people who do it, they call them wiggle watchers, because they're looking at the stock prices, how they go up and down, and they think based on how the stock price is going up and down every day, they can predict where it's going next. One thing I will say though, you know, because if there is someone who has more information than you, and they're buying stock because let's say they have insider information that the stock is going to go up because some really good thing happened that's still a secret. You will, on some of the tools in technical analysis will show you, hey, something's happening in this stock. Somebody is buying it up. We don't know why, but for some reason they are buying it up. And so technical analysis can help you see that, because it'll look at the change in prices when it breaks out of a pattern, and it'll compare it relative to normal trading volumes. And so these little indicators of what's happening in the market can at least tell you if more people are trying to buy or more people are trying to sell. So that's kind of where it's kind of a, you know, somewhat valuable. So like if you were to wanting to buy a stock, but then you look at the technical analysis and it says, well, a lot of people are trying to unload the stock. They're selling it. And maybe you want to wait before buying it to see what happens with the stock. So there is some value, and what some hedge funds have done, and which makes it very hard for small investors to compete in, is they built a lot of these rules for technical analysis into big supercomputers, and they park those supercomputing centers directly next to the exchanges, like the NASDAQ or the New York Stock Exchange's computers, right across the street. And they'll put in huge cables with like zero latency in terms of how long it takes the electrons to flow with the information. And so they're crunching these numbers constantly, and computers are making buy and sell decisions. And they've got all these rules developed by PhD finance and physics people who spend their time looking at little things going up and down and looking for relationships that, hey, we know when this happens, then the stock price goes up about 27 minutes later. And so it's very hard to compete with that. So I would be very cautious, if I were you guys trying to do something in this. So technical analysis, you're looking for patterns in past stock prices to predict the future. Wiggle watchers. Anyhow, semi-strong form is sometimes referred to as fundamental analysis. And here investors are trying to find mispriced securities by analyzing specifically financial statements, and then they'll own dividend discount model or other models to come up with the value of a stock and compare that to the current trading price. And if they see their valuation much higher than the current trading price, then they'll buy the stock, because the thought is that eventually the market will catch on that this company is worth a lot more than the current price. And so value investing is famous for that. That's what Warren Buffett does. You know, he'll do a valuation on a stock, and if he sees that his valuation is much higher than the current market price, then they'll buy the stock. And then the thinking is that in the long term, the rest of the world will kind of catch on, and the company will increase in value more so than the average company. Strong form efficient markets are all about insider trading, really. And there's definitely profit opportunities in that, but it's illegal. I just did a little search for insider trading, and it was not hard to find a lot of news stories about that. Someone at Amazon came up here. I'm guessing it was like someone probably related to in their financial office, I'm guessing. And they were probably closing the books, maybe on the quarter, and they told some of their friends what the earnings numbers or growth rates were going to be, because they knew once that information was public, then the stock price would probably move quite a bit, either up or down. I don't know what kind of information they had. Related to mergers and acquisitions here. Look at this. Even someone on a committee that oversees an index, the Dow Jones Industrial Index. You hear that on the radio if you listen to financial news. They were charged with insider trading because when indices change what companies are in their index, right? Because sometimes companies do really bad and they get thrown out of the index, and then some companies do so good that they put them in. And so when the companies go in and out of the index, that's a big deal. And usually their stock prices change because of all these mutual funds that invest in indexes. And how they invest in the index is they buy the stocks for all the companies in those indexes. So there's a big stock price jump when a company gets added. So that's why this person had an insider trading scandal. They probably let some friends know or somebody know about this. Rite Aid as well. Insider trading. So that happens all the time, but it's illegal. Here are some of the market anomalies that we know. And what I mean by market anomalies here, again, you have to remember the theory is that markets are efficient. And whenever we find a place where we can predict returns, meaning they're not unpredictable, if we're able to predict returns with some information, we call that an anomaly. We can't explain it. We don't know why. Why would we be able to predict returns? It seems like everybody should be doing this investment, right? If we know that companies located in Pleasanton have 10% higher returns than every other company every year, people should start buying up Pleasanton stocks, and then pretty soon the prices will be brought up so high that you don't get those returns anymore. But for market anomalies, we see its repeated pattern where certain types of stock have higher returns than their other stocks. And so here's a list of some of them. The earnings announcement puzzle. So companies that have big surprises in their earnings, they have anomalous returns after their earnings. For example, if a company has a really big positive surprise, they made much higher profits than people expected, we do see the stock price jump up that first day of the announcement pretty quickly. But then over the next couple weeks, we predictably still see the stock will just kind of drift upward, more so than the rest of the market. And so you would think that if people knew this, right, they would start trading on this information and drive that stock price a little bit higher on the first day. But that's not what we see. We see kind of a slow drifting of the stock price. And so it's kind of puzzle to the finance world that this is predictable, and we can see this happen a lot. The new issue puzzle. With IPOs, we do see that stock prices jump a lot that first day. And it's kind of a puzzle because from an academic's point of view, it seems like the companies are leaving money on the table because they should be asking for higher prices on the shares they're selling. And but it seems like that companies like to discount their shares a little the first day just to get everything sold and to get get a nice story in the newspaper, in the news about how, hey, XYZ stock is up 15% in the first day of trading. It kind of sends good messages and news about the company. The small firm effect. It seems like small companies have higher returns than large companies. And it's not every year. It's more like something like 60% of the time. And it shouldn't necessarily be that predictable, but it is. Some of the research has pointed to the fact that trying to look for, if you're getting a high return, there must be some extra risk involved, right? And so people are looking for that extra risk in small companies. And part of it may be explained because when there's a recession, small companies have a harder time getting financing. Big companies in a recession, they can still borrow money, but small companies often get squeezed out. And so we think this could help explain part of this small firm effect. The January effect. This is interesting. It seems that January, out of all the months, has the highest stock returns. And this is an average over between 40 and 80 years. This isn't just one particular year. This is where we look at the averages over a long time period, and we see, wow, that's weird. January has a statistically significant higher return than every single other month of the year. Part of the thinking behind this is that the rationale, we think, is that in December, there's a lot of tax loss selling going on. Investors will sell stocks that have gone down in value so that they can incur the loss and write it off on their taxes as a loss. And then in January, they turn around and start buying more stocks again. So that's part of the thinking. On the PE effect, this is the price to earnings ratio. We find that on average, over a long period of time, if you play the averages, low PE stocks have higher returns than high PE stocks. Now, this does not hold for the last, I would say, 5 to 10 years. And the reason being is because cheap stocks, so to speak, they haven't been doing as well the last couple of years, mainly because companies like Netflix, Facebook, Amazon, Google, that's where a lot of the returns in the stock market have been over the last couple of years, which, it's kind of different than it has been in the past. And a lot of these anomalies come from analyzing stock returns over like 30, 40, 50, 60 years. And so these are averages. It's not like you can pick one January and say, hey, I'm going to make more returns this January. No, this is something where if you play this investment game over 20, 30 years, then you will see that on average you did better in January. It's not one particular January. So that's, again, what makes it harder for smaller investors to take advantage of this. Firms that don't get a lot of attention seem to have higher returns. Firms that don't have Wall Street analysts from investment banks writing reports on them seem to get higher returns. It's kind of a strange thing. It's a little bit of a puzzle. The value line effect. There's a company that writes a newsletter called Value Line. Some of the bigger libraries will have it. You can just go look at it. And they also have an online website, obviously. And their stock picks over a long period of time seem to do pretty well. You can find them at Value Line. I think it's .com. So we have all these different things we can't explain. And so what has been done is a new area of finance, a newer area of finance called behavioral finance. And it's been developed to help explain some of these anomalies. And the thinking is that we as humans, as investors, we kind of have the same fears and we kind of behave the same way irrationally sometimes, and we don't always make the best investment decisions because of these fears that we have or behaviors to kind of combat risk. And one of those is called herding. And you can think about herding as kind of like, if sheep run away from something scary, they're all going to get together in a herd, right? Because they think there's safety in that herd. From an investor standpoint, my friends are all buying this stock, so it must be safe, right? If I buy this stock too, I'll be safer because I'm not the only one who's buying this stock. So we kind of see that in the investment world. People will watch other investors to see what they're doing, hoping that someone else knows what they're doing and that they can do well then. That's called herding. We find that when investors shape an opinion about a company, that when information comes out that's contrary to their opinion, they're very slow to change their mind. And I imagine, you can probably admit this, right? If you think a certain person is bad or something, or you can't trust them, or they're some other thing, and you see that person do something opposite to what you think, you're not going to change your mind right away, right? And maybe that's not totally irrational, but we do see in the investment world that when new information comes out, people don't process it quick enough, and it's predictable because we see when this information comes out, we can see stock prices like a new surprise earnings announcement. We can see, oh, there's a big surprise. Well, we know that the stock price is going to go up a little, but still, it takes investors time to realize that and kind of absorb that information. I don't care about that earnings announcement. I just know this company is going to do well. So that's what if a company had a bad earnings announcement. And yeah. Another thing we see that when stocks are up, investors are much more willing to bet even more money. So like, for example, let's say an investor says, you know what, I'm going to put in 50% of my money in stocks. But then they see, oh man, my stocks are up 15, 20% this year. You know what, I'm going to put in 90% of my money in stocks. And predictably, this usually does not do so well. We think it's part of the reason that we have stock bubbles sometimes where at some point when stock prices start going high to astronomical levels and everybody you know of is talking about stock investing, that's a good indication that the bubble is imminent and it's going to burst. So yeah, people change their view of risk once they've done really well. And I think this is analogous, and it maybe comes from casinos, where when people have won some bets, they feel like they're you know, they're playing with someone else's money now. It's house money. They didn't come into the casino with it, and they're going to start betting even more now. Obviously, not everybody does this, but we do find that enough people do this type of behavior that it can affect prices in the stock market. So that is behavioral finance. And that is all I have for today.